I shall be quick. I think it was Einstein who said that not all of us can be geniuses, but all of us can try to be concise. And I must begin by saying that it's so chilly here. I've been freezing there in the corner, but actually I feel as passionately about quantitative easing and all that Tim talked about as he does. So I'm sure I will warm up in the course of the proceedings today. Now, thank you very much for the invitation to speak today from the Institute of International Monetary Research, and well done, Tim, for setting it up, because it is extremely valuable. Now, I don't know how many of you know me, but I met Tim 17 years ago. Sounds such a long time ago, and I had joined Lombard Street Research straight after university. And I must say that during the first 5 months of working at Lombard Street Research and being in contact with Tim, I learned more about monetary economics than I did in the whole of the 5 years I studied in university. And bear in mind that during my master's degree at Warwick, I specialized in monetary and international monetary economics. So it was an invaluable lesson. And for your information, in order to judge what I'm going to say, you have to understand that Tim's influence on the way I look at the world and the way I analyze economies has been critical. At the same time, though, I was very fortunate to also work with two other great minds, which were Brian Redding and Charles Dumas. And they shaped the way I looked at the world as well. So I will not necessarily agree with everything that Tim has to say, and you will see over the course of what I have to say where our paths might start diverging. So, being the first today, I thought I would just set out the general themes and issues that every panel afterwards will discuss in greater detail, and I see the presentations that everyone has prepared are looking at specific issues in this very broad theme. Now, it's striking for me that 8 years after the global financial crisis, quantitative easing still seems to be largely misunderstood. And the most striking part of it all is that actually it's misunderstood by policymakers, by those who have actually applied it. I remember in November 2006, I was attending the annual ECB conference, and its subject was the role of money and monetary policy in the 21st century. I remember how my desperation grew, presentation after presentation, talk after talk. Policymakers were working off models that had no bearing on the real economy. And what's worse is that the low bond yields conundrum, the rapid asset price inflation, none of that seemed to have changed their thinking into the run-up of the global financial crisis. Why is that? Well, we've had 20 years during which really academics and policymakers have excluded money from their economic models. I'm not going to dwell on why that happened, but it is what happened. And also, wrongly, they separated conceptually debt management, from monetary policy. Another point that Tim very vehemently makes. And in financial markets, practitioners were aware that money, or liquidity as they like to call it, mattered, but they couldn't quite marry how that related to what central banks were doing and how they were looking at the world. Oops. So I want to outline very briefly of what were these model misspecifications. How come we had everyone working off models that had no place for banks, they had no place for money, they had no place for asset price inflation, and for that matter for global capital flows. So in academia and central banking, it seems that the neo-Keynesian model of looking at the world is the bedrock of all analysis. And there are several problems with this. The first problem is, of course, that it is assumed that everyone who wishes to borrow can actually do so, which of course we very well know is not always at all the case. The pitfalls don't stop here. And it's something which Tim taught me, which I think it's a very good way of thinking about it. You know, I remember as an undergraduate student of economics that I was taught the circular flow of income diagram. And that makes you, or gives you the impression that you can only spend money that is either earned or borrowed. And that's where asset prices, or wealth, if you like, is taken out of the equation, because obviously you can also spend, or indeed decide to pay down debt, money from the sale of assets. Earned, if you like, from the sale of assets, or acquired, not to use the same word, from the sale of assets. But conceptually that doesn't exist. And of course, worse still, it is assumed that there is only one interest rate that equilibrates, if you like, the quantity, the supply and demand for money, and that's the policy rate. And that determines all the other yields in the economy, which again is a big leap, because that's where banks come out of the equation, because they don't matter. And of course, global capital flows come out of the equation. So policymakers were ill-equipped, and academia was ill-equipped in dealing with this crisis. From my perspective, the sad thing is that 8 years later, we are pretty much still in the same boat. Now, another aspect which I think is quite important is that in economics, it's not a precise science. And often we use labels, if you'd like, to put forward a concept or an idea more powerfully. But these labels, if you don't understand what you're talking about, can be extremely dangerous. And I'm talking about the name quantitative easing. Because as Tim said, and I'm sure all of you will agree, certainly in this room, maybe not outside of this room, that quantitative easing wasn't a particularly new concept. But the term quantitative easing, as it wasn't called quantitative easing 20 years ago, was used first to describe what Japan was doing in the noughties. And that then colored the whole discussion about quantitative easing, and in particular, whether it is effective or not effective. Because it's important to realize that, if we define quantitative easing as purchases of assets by the state, whether it is the government or the central bank, it matters very much whether these purchases are from the banks or they are from the non-banks. In the case of Japan, and you can call these two different types of QE, Japan type and UK type, or type 1 or type 2, whatever you want to call them. The case was that Japan was doing the buying assets from the banks. There was no demand for credit, and banks weren't willing to give out credit, so it had very little impact in Japan until they introduced debt management into the mix and started shortening the maturity of government debt, and this was much more the type of shorter dated government debt that the banks would be buying. Now, if you don't understand, or if the theory is out of your mind, it's not something you've been taught at university, or it's not something that your colleagues or friends discuss about in this way, it's understandable why you would be in such a model. And I think then to afterwards layer, the understanding with the example of Japan, and then apply that to how you looked at what happened elsewhere afterwards, was another way of confusing the issue. Now, the third, if you'd like, confusion that exists is the issue about the importance of money versus credit. And again, Tim is very good in explaining things very clearly. And I remember a few years ago, he said, imagine an economy that there is no credit that year, for whatever reason. Obviously, economic activity will be impacted. But then imagine an economy where there is no money that year, for again, whatever reason. We have to go back to barter conditions. I haven't been in those for millennia. And you can imagine that the impact on economic activity will be much more dramatic. Even if the credit mechanism is hampered for whatever reason, economic transactions will still take place, or some economic transactions will still take place. Whereas if money disappears altogether, obviously it will be extremely difficult to continue our world as it is. And it is sad that from all the central banks that have deployed quantitative easing, only the Bank of England did QE for the right reasons. And I will read out here what says on their website, which is that the purpose of the purchases was and is to inject money directly into the economy in order to boost nominal demand. And I'm not sure that the Bank of England now would necessarily subscribe to those words, but certainly the Bank of England under Mervyn King did. And he remains very adamant that that was what he was trying to do. But everywhere else, it was credit easing. And it's strange because for Ben Bernanke, who was such a strong admirer of Friedman and Schwartz's work, that he would be so concerned with boosting credit and lowering long-term interest rates. And it's also peculiar because why would you want to be boosting credit in an economy where there is excess leverage and you're actually trying to deleverage in order to cleanse the system of this excess? It makes much more sense that as the deleveraging is going through, money is destroyed, either you pay down debt or you default. In order to prevent from this becoming a self-fulfilling downward spiral, you need to inject money in the economy in order to allow for transactions that would have taken place anyway to take place. Now, luckily, again, even though they did quantitative easing for the wrong reasons, in the US, the ECB is very much in the same boat of credit easing and credit spread compression or lowering long-term interest rates, and so is the Bank of Japan. But in the case of the UK, they did it for the right reasons and it worked. In the case of the US, they did it for the wrong reasons, but it worked because some of that quantitative easing was the type 2, was buying assets from non-banks. And very schematically, you could think that if there is an acute liquidity shortage or crisis in the banking system, then you can think we need to buy assets from the banks. Type 1 QE would work in an acute liquidity crunch. But if there is a solvency issue in the economy, then you need QE type 2. You need to buy assets from the non-banks. The ECB was too late. They should have done quantitative easing much earlier than they did. And I totally agree with Tim's assessment that the increase in regulation and the forcing banks to actually raise the capital to asset ratios when they were dealing with these huge losses was a huge contributor to the severity of the crisis. Although I don't think that that was the only thing that caused the crisis. In Japan, we are in very dangerous territory. So, in assessing whether QE is a palliative or a cure, which was the title of my presentation, I want to suggest to you, and we'll discuss that in more detail in a second, that because of this large misunderstanding of what it is that we're actually trying to do with QE, we are entering into a dangerous period now where quantitative easing could turn out to be, from what was a benign force in helping the global economy go through the adjustment, into a malign force of actually ending up with inflation, the wrong type of inflation at the end of this process. And in 2009, when there were a bunch of very well-known economists who came out and stated, I think they wrote a letter or an article, I can't remember, but it was about them warning, no, quantitative easing is the wrong thing to do because inflation will come straight away. I was not one of those people who thought that that would happen, neither was Tim, I'm sure, because we did realize that there was such massive deleveraging and drainage of money that certainly the asset purchases, the size of them, was not going to be enough to push broad money growth so well above what's necessary for the economy to grow at trend that we would get much worse inflationary outcome. But in Japan is where the story starts to get malign, because Japan in particular doesn't have any excess debt in the private sector. It dealt with that problem. it also, when you look at broad money growth, and when you see that its trend growth rate is about probably half to maximum 1%, with broad money growth at 2% or 2.5%, you don't really need much more. So to step on the QE pedal, which has largely translated into a competitive devaluation, at a time when the rest of the world continues to suffer from a genuine lack of consumer demand, has created very dangerous conditions. How this will work out, it's very difficult to forecast, because I think what we need to put into the mix here is that none of these economies are operating in a vacuum. And this is another mistake that policymakers have made. They look at their economy and they take the rest of the world as an exogenous influence. It hasn't been how the global economy has worked for decades. You have to start with the whole. You have to look at what are the key driving forces in the world, and how does that come down to the level of countries and regions. And in that sense, trying to just, and one other qualification, in the case of Japan, we haven't yet seen that money hit the non-bank economy, because the majority of the JGBs they have been buying from the banks. So it's type 1 QE that, as we know, unless there is demand for credit or the desire for banks to give credit, it doesn't necessarily move to the rest of the economy. But banks are running out of JGBs. So at some point, the Bank of Japan will either have to say we need to taper, or they will, if they keep the rate of asset purchases the same, they will have to buy assets from the non-banks. And at that point, these assets will hit the non-bank economy. They're most likely going to hit non-bank financial institutions, because unless, of course, they decide to buy shoes from households. And I'm a woman, so the first thought that came to my mind was shoes.
I'm very nice girl too.
It's going to be non-bank financial institutions. And we know that Japanese households have a huge desire to hold money balances, and they're flush with cash. 2/3 of their financial assets are in interest-bearing deposits, which are 3 times their disposable income. It's incredible. But financial institutions, a pension fund or insurance companies, you can't sit on mountains of cash indefinitely. And the most likely expression is going to be via a currency war. And we have on the other side of the equation the other major saver economy contributing to this lack of global genuine consumer demand, China. We're not going to take that development, given their structural growth weakening and the fact that actually from the major economies the yuan is the only overvalued currency and does need to come down. And in fact I will posit that for China to successfully adjust, that can't be done without the currency depreciating. So I'm afraid we're not yet out of the woods. And it's not because there are limits to monetary policy or quantitative easing has reached its limits. It's because largely of this misunderstanding of where we are and how it all works. And I hope that today's conference is going to be extremely informative, and also that the rest of us will then take that knowledge and disseminate it across the board, because at the end of the day we are all going to live with the consequences of it. Thank you very much, ladies and gentlemen.